Assalamu alaikum, students. This is your teacher Azka, and I teach business and accounting to O and A levels students. So for today, as you can see, that we are going to start the A levels accounting past papers October 2024 series. And for today, I'm going to start my first video. Not the first, basically, this is my second video because I think I already uploaded paper 4 for A2 level variant 2 a few days back or maybe few weeks back. Okay, so from now onwards, I'll be working on that. And there is one more video which is left yet, and this is related to O levels accounting, paper 2 variant 3, and I will be uploading that soon. Okay, so this is the code for AS levels accounting, A levels accounting. And we have 1 hour to complete the 30 MCQs. This is paper 1 variant 2. So now let's start. Okay, so we have the question number 30. Which statements correctly describe the cost volume profit analysis? Okay. Uh, so first one is that it assumes a linear relationship between cost, revenue, and volume. This is correct because CVP analysis assumes fixed and variable costs, which led to a linear relationship. So this seems to be the right option. Now let's see the D. Sorry, 2. It can be used in what-if analysis. So this is also correct as CVP analysis is commonly used to explore different scenarios and their effects on profit. So yeah, this is right. Third one is that it is a useful tool in long-term decision making. So this is not true because CVP analysis is generally more useful for short-term decision making rather than long-term. That's why it's not correct. D is that it shows how cost, revenue, and profit change in relation to sales volume. So this is correct as CVP analysis helps to understand that how changes in sales volume affect the profitability. So it means that option 1, 2, and 4 is right. So B option is the right option. Okay. So now let's see question number 59. The financial information for selling 6,000 worth of units in August was as follows. Okay. So now let's read it. So we have selling price, which is $40 per unit, variable cost 22, fixed cost is 12, and profit is 6. So selling price was reduced by 10% in September. Which level of sales was needed in September to achieve the same total profit as August? Okay, so to calculate the required level of sales in September to achieve the same total profit in August, so we need to follow some few steps. Okay. So if first of all we want to find out the profit per unit in August, profit profit per unit in August. So this is equal to selling price minus variable cost. So selling price is $40 minus 22, which is variable cost is $18. Okay, so total profit in August because units sold, which is 600 units, which is sold in August. Okay, so units sold in August, which is 600. So if you just want to find the total profit, so multiply the per unit profit with the total number of units sold. So this is 108,000. Okay, now the new selling price in August, which is increased by 10%. Okay, so the selling price was $40. Okay, and it is increased by 10%. So this is giving me the answer, which is 4 Okay, so 40 minus 4 is equal to $36. So it means that this is a new selling price. It is reduced. It is not, yeah, it is reduced. That's why we are deducting the 4 from the 40. But the variable cost per unit in September is same because there is no information related to change in the variable cost. Okay, so now if you just want to find out in September the profit per unit, profit per unit. So this is equal to selling price minus variable cost. Selling price is 36 now minus 22. So this is equal to $14. Okay. So we need to find out total profit in September to be equal to the profit in August, which was 108,000. Okay. So basically, we just want to find out that what is a required unit we need to produce. Required units in September. Okay, so what we need to do, we will see that what is the total profit in August divided by the total, or you can say that the profit per unit in September. Profit per unit in September. So the required number of units will be equal to 108,000 divided by $14. So this is equal to somewhere 7714.29 units. I just want to round off this one. So this is 7715 number of units. Okay. So this is the requirements. C is the right option. Okay. So now let's see the next one. Question number 28. Which items are included in the calculation of contributions to sales ratio? Okay. Uh, so contribution to sales ratio, what is the formula for the contribution to sales ratio? Formula is sales minus variable cost divided by sales. So this is the contribution to sales ratio is calculated using this formula. Okay. So it essentially compares the contribution margin, means sales minus variable cost to the sales revenue. So it means that sales revenue and variable cost are sales revenue and variable cost. Variable costs are the items included in the calculation as they are used to determine the contribution margin and the ratio. So it means that C option seems to be the right option. Okay. Now let's see the question number 27. Okay. In question number 27, the following information is available from the costing records. Okay, so we have this information. By how much are the overheads over-absorbed or under-absorbed? Okay. So we want to find out the overhead absorbed, whether this is over or whether this is under-absorbed. So we have the budgeted overhead cost, direct labor hours, overhead cost, or actual overhead cost incurred, and actual direct labor hours worked. So for calculate whether the overheads are over-absorbed or under-absorbed, we need to follow some steps. So first of all, we need to calculate the predetermined overhead rate. So predetermined overhead rate is, we will calculate this through this formula. Predetermined overhead rate is equal to budgeted overhead cost divided by budgeted direct labor hours. Okay, so the budgeted overhead cost was 32,000 divided by budgeted direct labor hours 4,000. So this is, it means that predetermined overhead rate is $8 per hour. Okay. Now we are going to calculate the absorbed overhead. So the absorbed overheads are calculated by multiplying the predetermined overhead rate by the actual direct labor hours worked. Okay, so the actual direct labor hours worked, which is 3,900 hours. And what is the predetermined overhead rate, which is $8 per hour. So to find out the absorbed overheads is equal to 8 multiply 3,900. So this is equal to 31,200. Okay. So now you're going to calculate the over or maybe under absorbed overhead. So now we're going to compare the absorbed overheads with the actual overhead cost incurred. Okay. So actual overhead cost incurred is equal to, which is 34,000. So if you just want to find out the over or maybe under absorbed overheads, so we will deduct the absorbed overheads minus actual overheads incurred. So absorbed is 31,200 and minus 34,000, which is actual. So the answer is in the negative form. So it means that since the result is in minus negative form, so overheads are under absorbed by $2,800. Okay. Uh, Now let's see the next question. Okay. Question number 26. The following budgeted and actual information is available. Okay. So we have the overheads, budgeted and actual, labor hours, actual and budgeted, machine hours, budgeted and actual. What would be the company's most suitable overheads at option rate? Okay. So to calculate the most suitable overheads at option rate, we need to choose between labor hours or machine hours. Okay. So as you can see that labor hours are huge in numbers. So that is why we will select the labor hours. So the formula for overhead absorption rate is overhead absorption rate is budgeted overheads divided by budgeted labor hours. Okay. So the budget overheads are basically 460 divided by the labor hours is equal to 28,750. And it is equal to 16 dollar per labor hour. So A option is the right option. Okay. Now let's see the next question. Okay, so in the question number 25, a customer places an order for 20,000 bricks. Which costing method will supplier use to price the order? Okay. So first of all, the batch costing. So it is used when a specific quantity of identical items is produced together as a batch, making it suitable for pricing bulk orders like the 20,000 bricks in this case. So this seems to be the right option, but let's see the others as well. Job costing. So job costing is used when each order is unique, such as custom project, which doesn't apply to standard production items like bricks. That's why this is not the right option. Marginal costing is concerned with the cost of producing one additional unit, not suitable for pricing an entire order. Unit costing refers to the cost per unit, which could be part of the pricing method, but it is not typically used as the primary method for the bulk orders like this. So A option is the right option. Okay, so now let's see the question number 24. The inventory movements of a business in 3 months period are shown. January, February, and March. Business uses the first out method is inventory valuation. What was the value of inventory at the end of the March? Okay. So in the January, as you can see, that the receipts is showing us that there's 100 units at $5 per unit. Okay. And 200 number of units at $6 per unit. So if you just want to find out the total inventory at the end of the January, total inventory at the end of January. So this is equal to 100 units multiply 5. So this is equal to 500. Okay. And 200 units multiply by 6. This is equal to 1200. Okay. So it means that this is a total inventory. There is a total units, which is 300. Okay. And the value is $1,700. Okay, now let's see the February transaction. So what happened in February? So in February, we issued 50 number of units. So it means that using the FIFO, the first 50 units issued are from the oldest inventory. So if you just see that oldest inventory's value was $5 per unit. So it means that the February transaction is showing us that the 50 units which we sold, we valued at $5 per unit. So it means that we issued the units for, and its cost is $250. So now let's see that what is the remaining inventory at the end of the fab. Okay. So from out of 100, there is now only 50 units. Okay. That is multiplied by 5. This is equal to 250. Okay. And the 200 is remain the same. 200 multiply 6. So this is 1200. So it means that there is total number of units which is 250 at the end of fab, and their total value is 250 plus 1200, and its total value is 1450. Okay. Now let's see the March transaction, which is 200 number of units issued. So 200 units cost per unit is not specified here. So assuming that no new cost provided, so we consider the existing cost. So issues in the March, issues is equal to 200 units. Okay. So using the FIFO, the next 200 units issued are from the remaining oldest inventory. Okay. So if you just see that 50 units is equal to 50 units at $5 each is 250. Okay. So 50 units multiply 5, this is equal to 250. Okay. And there is now 150 units, which is equal to multiply 6. This is equal to 900. So total issued, so 200 issued, 200 units, which is issued at the value of 1150. So the remaining inventory is only 50 units, okay, which is from the last 200 units, okay. And this will be equal to 15 units multiply 6. This is equal to 300. So it means that the final inventory value, which is only equal to $300. So D is the right option. Okay. Now let's see the next question. So number 23. Okay. So in question number 23, a business employs mechanists to make a single type of product. As demand increases, more mechanists are employed. Every time 8 extra mechanists are employed, 1 extra supervisor is needed. So which option best describes the total labor cost? Okay. So if you see the mechanist, so mechanist, its employment patterns as demand increases, more mechanists are employed. So what is the cost behavior of this? So number of mechanists varies directly with the level of production or demand. So it means that its cost type is variable because the cost changes in proportion to the level of activity. So variable and variable. And if you just see the supervisor, so every time 8 extra mechanists are employed, 1 extra supervisor is needed. So it means that the cost behavior is that when the number of supervisor increases in steps, for example, if you have 1 or 8 mechanists, you need at one supervisor. So for 9 to 16 mechanists, you need 2 supervisors and so on. So it means that this is the step cost because the cost remains constant with a range of activity but jumps to a higher level once a certain threshold is crossed. So it means that this is step. So D option is the right option. Okay, so question number 22. A sold at a cost of sale is 240,000. The gross profit margin is 20%. What are the sales for the year? Okay. So basically gross profit margin is gross profit margin is equal to percentage is equal to the GP over sales multiply 100. This is the formula for GP margin. Okay. So given that the gross profit margin is 20%, this means that gross profit is 20% of sales. Okay. So if you just want to express the gross profit in terms of sales, so let sales is equal to S and the gross profit. Gross profit is 20% of sale. Okay, which is equal to basically 0.2 multiply sale. Okay, so relationship between sales cost of sale and gross profit is equal to the sales is equal to cost of sale plus GP. Okay, so if it is substitute the noun values, so sales we don't know, but we know the cost of sale, which is 240. 240,000. Okay, plus 0.2 S, which is this GP. We just find it out, 0.2 multiply S. So if you just want to find out the sales, you just find out the sales, okay? So it means that S minus 0.2 S is equal to 240,000. Okay. So S is basically, we will assume that S is equal to 1. So 1 minus 0.2 S is equal to 240,000. Okay. So 1 minus 0.2 is equal to 0.8. S is equal to 240,000. Since we want to find out the S, so we will make this subject, and here this is multiplying, so it means that we'll transfer this here. So it will divided by the cost of sales. It is 240,000 divided by 0.8, and this is equal to S is equal to $300,000. Okay. Now let's see the question number 21. Okay. Now let's see the question number 21. Question number 21 says that company's return on capital employed, either we are talking about ROCE, decreased the 10 to 10%, okay, in the current year from 15% in the previous year. Directors have noted that following changes during the current year. Okay. Which changes could explain the decrease in return on capital employed? Okay. So what is the formula for ROCE? So formula for ROCE is equal to operating profit divided by capital employed multiply 100. And what is the formula for capital employed? So the formula for capital employed is total assets minus current liabilities, or we can say the equity plus non-current liabilities. Okay. So let's analyze each change. First one is that a substantial investment in non-current assets was funded by the new debentures. Okay. So how this will impact the ROCE? So increase in the non-current assets, this increase the capital employed. Okay. Okay. And new debenture, this increases the non-current liabilities as well. Okay. Also increasing the capital employed together. So if the operating profit does not increase the proportionally, so ROCE will decrease. So it means a conclusion that this change could explain the decrease in ROCE. So one option seems to be the right option. Now let's analyze the second option. Second option is that there was an increase in the current liabilities. So how this will impact the ROCE? So increase in current liability, this reduces the capital employed. Since capital employed is equal to total assets minus current liabilities. Okay, so if the operating profit remains the same or decreases, so ROCE could decrease. So this change could also explain the decrease in ROCE. So it means that B option is also seems to be the right option. Okay. The expenses to return revenue ratio increase. So higher expenses relative to revenue, this reduces the operating profit. Lower operating profit directly reduces the ROCE. So this could maybe change explain to decrease in the ROCE. So now let's see the 4. The rate of interest on companies' large overdraft increased. So higher interest expense, this reduced net profit but does not directly affect the operating profit. So since ROCE based on operating profit, so this change does not directly explain the decrease in the ROCE. So that's why this change does not directly explain the decrease in ROCE. So if you see the 1 and 2, so both changes could explain the decrease in ROCE. If you see the B, 1 and 3, so both changes could explain the decrease in ROCE. Okay, and if you see the 2 and 4, so basically change 2 could explain, but change 4 does not directly affect the ROCE. And if you see the D, so change 3 could explain, but change 4 does not directly affect the ROCE. So 1 and 3 are the changes that could explain the decrease in return on capital employed. So it means that B option is the right option. Now let's see the question number 20, that which ratio measures the efficiency of a business. First one is the asset test ratio. So asset test ratio measures a company's ability to meet its short-term obligations with its most liquid assets. And its formula is current assets minus inventory divided by current liabilities. This is its focuses on liquidity, not efficiency. Let's see the markup. Markup indicates a percentage added to the cost price to determine the selling price. And its formula is selling price minus cost price divided by cost price. So its focus is on pricing strategy, not the efficiency. Now let's see the non-current assets turnover. So it measures that how effectively a company uses its non-current assets to generate the sales. And its formula is sales divided by non-current assets. So its focus is basically efficiency in using the non-current assets. Let's see the D. D is return on capital employed. So it measures the profitability and efficiency with which a company's capital is employed. And its formula is operating profit divided by capital employed multiplied by 100 and overall efficiency and the profitability. So it means that non-current assets turnover is only, it specifically measures that how efficiently a business uses its non-current assets to generate sales. So making it the ratio that directly measures the efficiency. So that's why C option is the right option. Okay, now let's see the next question. Okay. So statement of financial position of a company at 31st December showed the following. Issue share capital, which is this, 200,000 ordinary shares at $1 per share. This is share capital and this is the number of shares. And this is the par value. During the following year, the companies carried out the following. Number 1. On 1st January, made a right issue of 1 ordinary share for every 5 ordinary shares held. And the share issue price was 1.50 per ordinary share and the issue was fully subscribed. On 1st July, made a bonus issue of 1 ordinary share for every 4 ordinary shares held at that date. What was the amount of cash received by the company in respect of these transactions? Okay. So on 1st January, this is like on 1st January, 1 ordinary share for every 5 ordinary share held And what is the existing shares? Existing shares is still 200,000 ordinary shares. And right issue ratio is 1 for 5. So it means that number of new share issued is equal to 200,000 divided by 5 is equal to $40,000 number of, sorry, per thousand number of shares. So issue price per share is 1.50. Okay. So it means that the cash received from right issue is equal to 40,000 multiply 1.50. This is equal to 60,000 cash received. Okay. And if you see the bonus issue. On 1st July, I made a bonus issue for one ordinary share for every 4 ordinary shares held at the date. So basically, mm, mm, mm. So there is no issue price for the bonus issue. That's why there is a only $0 cash we will receive from the bonus issue. That's why the right answer is the B. We receive the amount only by issuing the right issue. Right. Okay. So let's see the question number 18. Okay. Now let's see the question number 18. A company issued a shares at a premium, okay, in which financial statement would the share premium appear? Okay. So the first one is statement of changes in equity and the statement of financial position. Okay. So what is share premium? Share premium is the amount received by a company from issuing shares at a price above their nominal par value. It means that if a company issues share with a nominal value of, let's say, one each, um, maybe for issue price is 1.50. So it means that the share premium will be $0.50 per share. And how we will treat the share premium account. So this is a reserve account in the equity section. So of the company's financial statement. So it appears in the financial statement. We appears in the statement of financial position, which means the balance sheet. The share premium is shown under the equity section, typically as a separate line item within the reserves. And it also shows in the statement of changes in equity as well. So this statement shows the movements in equity during the period, including changes in share premium account as well. So A seems to be the right option, but let's see the other one, B. B is saying that it is only will show in the statement of financial position. So while the share premium does appear in the statement of financial position, it is also appear in the statement of change in equity as well. So this is wrong. C is statement of profit and loss statement of the financial position. So the share premium does not appear in the statement of profit and loss. Statement of profit and loss only again, the share premium does not appear in the statement of profit and loss. A option is the right option. Okay. Okay, so question number 17 is L, M, and in partnership, sharing profit and losses in the ratio of 3:2. They have the following current account balances. Okay. So this is opening balance and this is the closing balances. The balances at 31st March 2024 are after taking into account as the following: interest and drawings, interest and capital drawings. What was the residual profit to be shared between L and M for the year ended 31st March 2024? So what we have to do, we have to prepare the current account for both of them, the L and M. This is the column for L and this is column for M. This is for L and this is for M. This is the credit side, this is the debit side. Okay, so first of all, as you can see that we have the credit balance in the opening balance PD for the L. So we will show this here. And we have a debit balance, which is 4,500 for M. This is a negative balance. We will show this here. And if you see the credit balance for L, which is 14,200, this is the credit balance. 14,200. So we will show this here. Because automatically it will move towards the credit side. The closing balance, first of all, should show on the opposite side because this is the credit balance. So it means that it will show here as the old balance PD, and this is 14,200. But closing balance we have to show here, and 6,200 is the debit balance. So we will show this here. And let me show here. Interest on drawing is 1,100 for M and L. So we'll record the interest on drawing on the debit side. Interest on capital is 3,000 and 2,000. So we will record here the interest on capital, which is 3,000 plus 2,000. Drawings are 10,000 and 15,000. So we will record drawings here. 10,000 and 15,000. Okay, so profit share should be recorded on the credit side, and we don't know that what is the balance for the profit share. So now what we have to do is now total the credit side on credit side of L and M and deduct the whole debit side of M and debit side of L. So you will get the answer 19,200 for L and 12800 for M. 12,800. So since we are trying to find out the residual profit, which is need to be shared yet. So we want to find out the residual profit. So we have to add the both partners' profit here, which is 19,200 plus 12800. And this is equal to 32,000. This is the T. Now we are going to see the next question. Question number 16. Sold data statement of profit and loss shows the following information. Opening inventory, opening expenses, profit for the year. Closing inventory is 10% less than the opening inventory. All goods sold are marked up by 50%. What are the purchases for the year? Okay. So basically, first of all, let's find out the closing inventory. So closing inventory is basically is equal to opening inventory minus 10% of opening inventory. Okay. So opening inventory is equal to 5,000 minus, uh, if we just multiply the 55,000 with 10%. So you will get the answer 55,000 minus 500. So this is equal to 4,500. So 4,500 is the closing inventory. Okay. Now we are going to determine the cost of goods sold. And this is equal to opening inventory plus purchases minus closing inventory. Okay. So opening inventory is 5,000. So like if we need to find the cost of goods sold for using the profit and markup information. Okay. So uh if we want to find out the we can use a profit formula to find out the cost of goods sold. Okay. Uh, so profit is equal to sales revenue minus cost of sale minus operating expenses. Okay. Profit is equal to 5,400 and sales revenue is we don't know, minus cost of goods sold again we don't know, minus operating expenses equal to 3,000. You want to find out the sales revenue is equal to 5,400 plus cost of goods sold plus 3,000. Okay, so it means that the cost of goods sold is plus 8,400, which is 5,400 plus 300. So this is 8,400. Okay. Now let's use a markup to relate the cost of goods and revenue. So markup is basically 50%. Okay. So if we just want to write this as it is, sales revenue is equal to cost of goods sold. Okay. And plus 50% of cost of goods sold, because the markup is basically 50% of the cost of goods sold. So 50% multiply cost of sale. Okay. Um, so this is equal to 1.5. Okay. Because cost of sales is equal to 1. So 1 plus 50%, which is 0.5. So this is 1 plus 1.5 multiply cost of goods sold. Okay. And so since cost of goods sold was equal to plus 84,000, this one, sorry, 8,400, not 1,000, 8,400, okay? And this is equal to 1.5 multiply cost of goods sold, okay? So, 1.5 multiply cost of goods sold, and now we are going to shift it here, minus cost of goods sold. This will become in the minus is equal to 8,400. So 1 minus cost of goods sold, this is equal to 1. So 1.5 minus 1.5. So this is equal to 0.5 multiply cost of goods sold is equal to 8,400. Okay. And this is equal to cost of goods sold is equal to 8,400 divided by 0.5. Cost of goods sold is equal to 16,800. Now we can easily find out the purchases. Okay, cost of goods sold is equal to opening inventory plus purchases minus closing inventory. We know that cost of goods sold is equal to 16,800 is equal to 5,000 is opening inventory plus purchases we don't know right now, and closing inventory was 4,500. Okay, so we will make this subject, P is equal to subject. and this is 16,800. We will shift it here. Minus 5,000, receive the signs, plus 4,500, and this is equal to 16,300. This is the purchases. So $16,000, 300 are the purchases. Now let's see the second 15%. Okay, so the following information is available for a sole trader. Allowance for recoverable debts at the start of the year, which is 1,400. Total trade receivable at the end of the year, which is 36,000. At the end of the year, it was decided to write off $1,000 as recoverable debts and maintain the allowance for recoverable debts, which is 3% of receivable. What is the entry in the allowance for recoverable debts account? Okay. So total trade receivables um, at the end of this year is 36,000 and allowance percentage is 3%. Okay. So if we just want to find out what is the required allowance then. So this is equal to 3% of 36,000. So this is equal to 1080. Okay. So now we are going to adjust for irrecoverable debts written off. So irrecoverable debt is written off, which is $1,000. Okay. So how this will affect on trade receivable? So it means that your trade receivable will decrease by 1,000. Okay. So it means that now your new or your net trade receivables will be equal to 36,000 minus 1,000. This is equal to 35,000. Okay. So required allowance for after write-off, it is 3% of 35,000 was, we just want to multiply this 3%. So this is equal to 1050. Okay. So if we just compare with the existing allowance, so allowance at the start of the year, which is 1,400. Okay. And required allowance at the end of the year, which is 1050. So now it's just about to find out the difference. So basically it has a difference, which is equal to 1,400 minus 1050. Okay. So this is equal to $350. So since the required allowance is less than the existing allowance, so we need to reduce the allowance. So what will be the entry? Debit, we will debit the allowance account to reduce it with the $350. So the entry in the allowance for irrecoverable debts account is $350 credit debit. Okay. Question number 14. The current assets of a company include the balances on both the rent payable and the rent receivable accounts. So what do these balances represent? Okay. So basically, this is the current assets. Okay. So the rent payable is the expense, and we use the okay. So we use a mnemonic for expense account, which is P A A P. So if in the rent payable account, it is showing the current assets. So if your expenses are prepaid, so this is known as your current assets. Okay. So it means these two seems to be the right option in the rent payable account. And if you see the rent receivable, rent receivable account. So this is the income account. For income account, we use the mnemonic, which is A, P, A. Prepaid is liability, accrued is basically the current asset. It means that we given the services, but we haven't received the amount yet. So we can claim on this amount. That's why this is the Like the accrued balance in the rent receivable account shows this is the current asset for the business. So this is accrued and accrued. So it means that C option is the right option. Okay. Now let's see the 13. Okay. So company prepared a sale as a control account. Balance did not agree with the total of the sale as a balances, which were 42650. Following errors or omission were discovered. Okay. First one is that an irrecoverable debt of $500 in journal has not been recorded in the sales journal. Okay. Basically, we just want to find out what was the correct total of the sale as it balances. Okay. So let's see the first entry. That there's an irrecoverable debt of $500 and it is not recorded in the sales journal. So how this will impact the sales ledger, sorry. So the sales ledger balances are overstated by $500. So how we can adjust it? So the adjustment is that we will subtract the $500 from the total. So we will subtract the $500 from the total. Okay. Now let's see the second one. Sales journal has been incorrectly added and must be reduced by 750. So this is the error where sales journal must be reduced by 750. Okay, and the sale and the balance are overstated with 750. It means, so how we will adjust it? So we will subtract the 750 from the total. Okay. Now let's say it's true. The sale and the control account includes a discount received, which is $400. It should have been discount allowed, which is $600. So discount received 400 was included instead of discount allowed, which is $600. So how this will impact the sale ledger? So sale ledger balances are understated by 200. 600 minus 400. So this is basically understated by 200. So that's why we will add the $200 to the total. Okay. The fourth error is sales to J Brown of 640 have not been added in his account. So sales of 640 not recorded in J Brown's account. So your sale ledger balance are understated by 640. So we will add the 640, okay, to the total. So now what was the initial total? Initial total is this 42,650. Okay. So now we will subtract the 500 from here, subtract the 750, okay, add 200 and add 640. So this is uh, 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 okay. So 42650 minus 500 minus 750 plus 200 plus 640. So this is equal to 4. This is basically equal to 42,790. Okay. So D option seems to be right. Okay. Now let's see the second 12th question. Hmm. Which item will be entered in the debit side of the purchase of the control account? This is a PLC. Contra with the sale of the control account. Okay. So contra with the sale of the sales ledger control account, it will basically uh decrease a PLC, decrease your liability, and this will record here. And discount received. So discount received, of course, it will also decrease the PLC, so this will record here. Return inwards is not a part of PLCA, this is the part of SLCA. So 1 and 2 only. Okay. Now let's see the say 11th question. Okay. So cash book of a business showed a bank balance which is 39,900. This differs from the bank statement balance. The bank statement is included bank charge of 250, a direct debit of 3280, and a credit transfer of 300. None of these amounts had been entered in the cash book. A payment of 620 entered in the cash book had not yet been presented for payment. So what was the balance on the updated cash book? Okay. So initial balance is 3900, which is this. Okay. So now what adjustment we need to do? So first of all, there are bank charges, which is 250. So it is not yet recorded. And there is a debit balance. It is also not yet recorded. Credit transfer, this is also not yet recorded. Okay. And this is unpresented check, which is not yet recorded, 620. So now we are going to update the cash flow. So bank charges, this reduces the bank balance. So we will subtract the 250. Okay. And direct debit. This reduces the bank balance. So again, we need to subtract 3283. Okay. And the credit fund transfer, which is equal to 300. So this increases the bank balance. So that's why we will add 300. Okay. So if we just calculate it, so at the end, you will get the answer, which is $67. Okay. So basically, they are asking us to find out the balance on the updated cash flow. This is very easy. 670 is the answer. Okay, now let's see the question number 9. Okay. So in the books of trader, discount receipt, which is $1,400, have been posted correctly in the supplier's account, but debited in the discount allowed account. Okay. So basically, your discount received account should be credited with 1,400. But what we did, we debited the discount allowed account. We debited the discount allowed account with 1,400. Now what we have to do, we have to reduce the discount allowed account, and we have to increase the discount received account. So what we will do, in order to increase the discount received account, we will credit the discount received account with 1,400. Okay. So we will credit the discount received account with 1,400, and we want to decrease discount down account. That is why we will decrease it by crediting it. And in the debit account, there is suspense account. A option is the right. Question number 8. Okay, so now let's see the question number 8. The totals of the trial balance of business is not agreed. The following errors were discovered. First one is the wages account had been overcast. So let's see first of all the requirement. So after the appropriate corrections were made, the trial balance totals agreed. So what was the difference between the trial balance totals before the correction were made? If you just want to find out a difference in trial balance, so we can easily find it out through the suspense account. So basically, the various account which is had been overcast by the 550. So it means that if it is overcast by 550, so it means that your wages account we will credit the wages account because we overcasted it. So your wages account will be credited and your suspense account will be debited by 550. And sales account which is undercast by 400. So it means that we will be increasing it. So your sales account will be credited and the savings account will be debited. Okay, and the credit sale of 150 had been recorded on the sales invoice as 510. So sale invoice is basically the business document, and there is no need to record in the suspense and trial balance. So it means that if it is total the 550 and 400, so there is a difference in trial balance which is 950 before the correction. So D option is the right option. Now let's see the next question. Okay. Now let's see the question number 27. Okay, question number 7 says that Ryan purchased a van for $6,000 on 31st December 21. It is his policy to apply 25% per annum reducing balance depreciation for each part of the year the asset is held. Ryan traded the van in on 1st July 24 for a 6150 reduction in the cost of a new van. What was the total profit or loss made on the disposal of the van? Okay. So basically purchase date is 31st December 21 and depreciation rate they are following it is 25% per annum by reducing balance method and trading date which is 1st July 2024. Okay. So the depreciation for 16,000. So we just want to find out the depreciation for 16,000. So this is equal to 4,000. So carrying amount at the end of the 2022 will be 16,000 minus 4,000. So the carrying value will be 12,000. This is the net book value. Or you can say the carrying value. And if you see the year 2023, so since we are using the RB, so we will apply 25% on the carrying value. So carrying value is 12,000. Multiply 25%. So this is equal to 3,000. Okay. So carrying value at the end of 2003 is equal to 12,000 minus 3,000. So this is equal to 9,000. Okay. And in year three, like in year three, 2024, depreciation for part of the year 1st January 2024, 1st January 2024 to 1st July 2024. This is basically equal to 6 months. Okay. So it means that now we will find out the depreciation for 6 months only. So 9,000 multiply 25% and multiply 6 over 12. And this is equal to 1,125. Okay. So the carrying value at 1st July 2024 will be 9,000 minus 1,125 is equal to $7,875. Okay. So now let's find out its trading value. So trading reduction on new van is trade in reduction for new van is $6,150. So this is trade-in value, which is 6,150. So now calculate the let's calculate the profit or loss on disposal. So carrying value at 1st July 2024, it is 7,875. And trading value is 6150. So there is a loss on disposal clearly, which is equal to 7875 minus 6150. This is equal to $1725. This is a loss on disposal. Okay. Now let's see the question number 6. Okay, non-current assets can be depreciated using the number of methods. How is the most appropriate method decided? Okay, so first one is that a method chosen improves the profit for the year for the business. So, the primary purpose of depreciation is to allocate the cost of an asset over its useful life, not to manipulate profit. So, choosing a method solely to improve profit is not appropriate and goes against accounting principle. So that's why this is not a valid criterion for selecting a depreciation method. Now let's see the B. B is the method chosen is easily understood by regulator for the financial information. So while it is important for financial information to be understandable, so the ease of understanding should not be primary factor in selecting a depreciation method. So the method should accurately reflect the assets usage. So that's why this is not the most appropriate criterion. Now let's see the C. Method chosen is easy to calculate. So simplicity in calculation is beneficial, but it should not override the need for the method to accurately reflect the assets usage and consumption of economic benefits. So that's why this is not the most appropriate criterion. Let's see the D. The method chosen reflects the pattern of use of the non-current assets. So the most appropriate depreciation method is one that best matches the pattern in which the assets economic benefits are consumed. So this ensures that the depreciation expense accurately reflects the asset usage over time. So this is the correct criterion for selecting a depreciation method. B option is the right option. Okay, now let's see the question number 5. Okay. The draft profit for the year for a business is 53,000. During the year, business acquired a new premises and included the following costs in the cost of the premises, which is legal fee and insurance. Business does not charge any depreciation on premises. What is the revised profit for the year? Okay, so legal fees is 1,500, insurance is 4,500. So legal fees, these are the typically capitalized as part of the cost of acquiring the premises because they are directly attributable to the acquisition. And insurance, this is usually a revenue expense and should be charged to the profit and loss account as it relates to the period's operations, not the acquisition cost. So it means that insurance, which is 4,500, should be treated as an expense and deducted from the draft profit. So what is the draft profit, which is 53,000? Okay, minus 4,500. This is equal to 48,500. Okay. Now let's see the uh, question number 4. Okay. Which item is a capital income? First one is bank interest received. So this is income earned from investment or deposits of bank. So revenue income as it is a regular income system. So that's why this is not the part of capital income. B is proceeds from sale of business premises. So this is income received from selling a long-term asset. This is business premises. So this is capital income as it results from the disposal of the capital asset. C is rental income from property. So this is income earned from renting out property. This is a revenue income as it is a regular income stream. That's why this is not the right option. Sale of inventory to a customer. So This is income from the sale of goods that are a part of business regular operations. So this is a revenue income as it is part of the core business activities. That's why this is not the right option. Okay, now let's see the next one. Peter is current customer of John. He set up his account of $200. He pays by check and receives a cash discount of 5%. Which entries are made in John's book of account to record this transaction? So account owed by Peter, which is $200, and cash discount received 5% of 200. So this multiply this 5%. So this is equal to $10. So 200 minus 10, this is equal to 190. So 190 is amount received by John. Okay, so it means that we will debit the bank account. Okay, we will debit the bank account, which is 190 amount which we received, and we will debit the uh, discount allowed, and this is $10. And credit, we will credit the Peter's account since he's a customer. This is $200. So it means that option A is the right option. Now let's see the question number 2. So a purchases ledger clerk has to use password to access the ledger in a computerized accounting system. What is the purpose of the password? Okay. First one is that to limit access to purchase ledgers by others. So passwords are primarily used to restrict access to sensitive information, ensuring that only authorized personnel like purchase ledger clerk can access the purchase ledger. So in conclusion, this is the main purpose of the password. Let's see the B, to prevent the clerk accidentally deleting the supplier's account. So while passwords restrict access, they do not directly prevent accidental deletions. So accidental deletions are typically managed through the user permissions and confirmation prompts, so not just by password. So this is not a primary purpose of the password. Now let's see the 3, to stop the clerk recording the fraudulent and unauthorized invoice. So while passwords restrict access, they do not directly prevent fraudulent or unauthorized actions. So fraud prevention typically requires additional controls such as audit trails, approval processes, and segregation of duties. So in conclusion, this is not a primary purpose of the password. So the primary purpose of the password is to limit the access to purchase ledgers by others. So this ensures that only authorized personnel can access sensitive financial data. So we only. Okay. So a business. Last question is question number 1, that business sells computers when it values its inventory. It excludes the value of inventory that is more than 1 year old. This is because it may obsolete. Obsolete. Which principle, accounting principle does this in demonstrate? Okay. So it is basically prudence principle because this principle requires that assets and income should not be overstated. So and liabilities and expenses should not be understated. So it emphasizes caution in financial reporting, especially when there is an uncertainty. So by excluding the value of inventory that is more than 1 year old, as it may be obsolete, so the business is being cautious and avoiding the overstatement of its inventory value. So this aligns with the prudence principle. But let's see the others. First one is a going concern. This principle assumes that business will continue operating in the foreseeable future. It is not relevant here. Historical cost, this principle states that assets should be recorded at their original purchase cost. It does not apply the exclusion of obsolete inventory. Realization is this principle states that revenue should only be recognized when it is realized. It means that earned. It is not relevant to the inventory valuation. So C option is the right option.